Across the institutions of global finance, a new digital architecture is consolidating. It relies on stacking four technologies into a unified operational grid: artificial intelligence, biometric digital identification, central bank digital currency, and an integrated digital surveillance layer. Within this framework, access is strictly permissioned. Algorithmic decisioning models handle credit scoring and underwriting, while biometric scans serve as the mandatory gateway for customer due diligence and identity verification. Central bank digital currencies and their tokenized equivalents function as the money substrate. Because this substrate is programmable, it enables continuous, integrated compliance telemetry. Every transaction transmits data directly to centralized supervisory hubs, acting as the final layer for enforcement and revocation. Confronted with this architecture, a demographic subset will decline participation. Driven by privacy concerns, opposition to state overreach, or a desire to avoid systemic fragility, this resistant remnant unplugs entirely, operating outside the official financial perimeter. Unplugging creates an immediate mechanical problem. The laws of economic physics still apply to a population that has left the grid. They require mechanisms to hold value across time, transfer liquidity across distances, and pool risk against disaster. To conduct daily economic life, this population must construct alternative institutional vehicles. This requires building an off-grid financial institution, or OGFI. Operating an OGFI requires manually engineering the 10 canonical functions of a modern commercial bank, from custody and clearing to credit creation and dispute resolution, without relying on any digital substrate. Remaining economically active outside the grid requires moving beyond primitive barter to the systematic engineering of analog banking systems. An off-grid financial institution operates under four strict negative constraints. It cannot rely on algorithmic underwriting. It cannot use biometric KYC protocols. It must avoid the digital money substrate, and it cannot participate in automated compliance telemetry. The immediate structural consequences of these constraints is physical. Stripped of electronic ledgers, the institution must revert to holding physical, tangible assets to warehouse economic value and back its issued instruments. This introduces the asset-to-function constraint. Cross-referencing tangible asset classes against the canonical functions of a bank reveals a highly variable heat map. No single tangible asset performs all 10 banking functions perfectly. Abstract assets fail across the board in this environment because they require digital ledgers and centralized verification to exist. Off-grid finance requires assets with independent physical properties. Precious metals score highly as a store of value and for interjurisdictional clearing. They are durable, universally recognized, and highly portable relative to their purchasing power. However, precious metals are poorly suited to retail microsavings. The indivisibility of metal at the smallest end creates a severe friction, driving up retail wholesale spreads on fractional physical coins and penalizing small depositors. Labor time scores highly as a unit of account anchor, providing a stable, intuitive metric for pricing goods and services within a localized community. But labor time fails as collateral. The institution cannot physically seize or liquidate a borrower's future labor time to secure credit creation if that borrower defaults. Because physical assets possess isolated operational strengths and weaknesses, an OGFI cannot function on a single standard. It survives by engineering a multi-asset balance sheet. With a physical asset base established, we can translate the most complex canonical functions of a mainstream bank into an off-grid environment. We start with Function 4, credit creation and lending. Mainstream banks rely on digital credit bureaus to solve the asymmetric information problem, assessing risk based on decades of financial telemetry. An OGFI lacks this data entirely. The off-grid solution replaces algorithms with localized social and physical mechanics. The institution relies on physical collateral chains held in custody, graduated lending limits that expand as borrowers prove reliability, and distributed guarantor liability, requiring members of the community to personally pledge material backing. This reliance on physical collateral brings us to Function 5, custody and collateral intermediation. Mainstream finance dematerializes assets into a central securities depository. Off-grid, holding physical bearer assets creates massive, localized physical vulnerability. To mitigate this, OG-Fi custody mechanics require dual-control physical vaults, redundant paper registries that track the chain of custody, and localized mutual aid insurance pooling to cover potential losses. Finally, we examine Function 8, clearing and settlement. Internal clearing within a single OG-Fi is straightforward. An officer reconciles obligations by debiting and crediting member accounts on a paper ledger. Inter-OG-Fi clearing requires settling balances between completely separate institutions. Without an electronic real-time gross settlement system, this inter-institution clearing becomes the primary bottleneck to scaling. Closing obligations requires exchanging bilateral paper drafts backed by the periodic, physically escorted transport of physical metal reserves. Removing digital wires shifts the engineering burden from software networks to human trust networks and physical security protocols. If the mechanical blueprints for parallel finance are clear, we have to ask why massive, fully independent OGFIs are not operating globally today. This chart plots historical and contemporary analog institutions to reveal the mathematical limit of off-grid scaling. The y-axis measures off-grid fidelity, an institution's degree of independence from state or digital infrastructure. The x-axis measures functional performance, the scale, coverage, and efficiency of the banking services it provides. High-fidelity historical analogs like Hawala networks and West African Raskas sit at the extremes of independence. These models are entirely unsupervised and resilient against state coercion, but their operational capabilities are restricted. They are functionally capped to providing basic cross-border value transfer or highly localized microsavings. When we plot mid-fidelity analogs, such as 19th-century United States free banking issuers or the modern Sardex mutual credit circuit, a strict inverse correlation appears, forming a clear trade-off frontier. The historical reality is that as these institutions expanded their services and scaled their membership, they were forced to slide down the fidelity axis. Achieving efficiency required adopting digital ledgers or accepting mainstream regulatory accommodations. This creates two distinct historical failure modes for parallel finance. The institution either faces absorption into the mainstream regulatory perimeter, or it ossifies into a localized symbolic operation with marginal economic impact. The defining challenge for a modern institutional designer is to break this historical trendline. Surviving means engineering a structure that actively pushes into the hypothesized upper target region, achieving true functional scale without compromising the strict ABCD constraints. Pushing into that target region requires navigating specific operational failure modes within a hostile, highly surveilled environment. Physical vulnerabilities are immediate. The institution must survive vault breaches, the partial loss of assets in transit, and the repudiation of forged paper instruments. Existential vulnerabilities are equally dangerous. If the financial network outgrows the social collateral that enforces its local dispute resolution, it suffers from scale-induced degradation. Members default because the reputational cost of doing so is no longer severe enough to constrain behavior. To survive these failure modes, the institution's development must align precisely with the broader rollout of the global digital architecture. Phase 1, the pre-transition period, represents the survival window for institutional designers. An institution's long-term viability is determined by the preparation executed during this phase. Accumulating physical assets, acquiring analog security printing tools, and forming local trust networks must happen before the digital architecture achieves full active rollout. The off-grid financial institution applies first principles economic engineering to the problem of sovereignty, securing financial life through deliberate analog design.